And welcome back to the Teaching Tax Flow podcast, episode 113 today. We promise they did not send us this question to convince you of, but we are going to answer it the best we can, which is, should I pay my spouse? But before we dive into this one specifically, let's take a brief moment and thank our episode sponsor.
This podcast is sponsored by Reps Tracker. Are you a real estate investor who is bogged down with the huge tax burden? Real estate investing can open the door to powerful tax benefits. Reps Tracker can streamline the process of accelerating these opportunities. To take advantage of a special TTF community discount, go to teachingtaxflow.com/reps, R-E-P-S, and use the code IFG. Better yet, click on the link below in this episode's show notes to go directly to the Reps Tracker sign-up page.
All right, everyone, you're back here again with Teaching Tax Flow. As you heard in the intro there, we are going to talk about, should you pay your spouse? Or even if you're not the one in question here, your spouse is probably wondering or interested, right? If you should be paying them. So as I mentioned there in the intro, all kidding aside, we are going to talk about your business, not all your business, but to a certain extent. And best person we can think of to do that, Chris Pacuro. Welcome back to your own show, buddy. How's it going?
Oh, man, happy holidays. It's great to be back with you and the Teaching Tax Flow community. We've just had an amazing just run of really good shows, guests, variety of topics. And I want to personally thank the Teaching Tax Flow community, specifically our private Facebook group. If you are hearing this and you're in our group, it's called Defeating Taxes. Give yourself a round of applause. Congratulations. If you are not in Defeating Taxes, now you're on Santa's bad list. Let's get you in there. Yeah, don't get on the bad list, John. Go to defeatingtaxes.com. Defeatingtaxes.com will get you right there. You can post anonymously in there. It is a community that we work together. There are taxpayers, there are tax professionals, there are strategic tax planning implementation partners in there to legally and ethically defeat taxes or reduce taxes you pay in your lifetime. Why am I going on about this fine group? Because this group is the one that gives us a ton of show ideas, including this one. This is a common question we get in our private CPA practice, but it's also, John, you've been traveling around on the Teaching Tax Flow bandwagon for a few years now, and you hear the questions, and they're valid questions. And a lot of times, you do have a business where there are two spouses working in the business, and it might make sense to pay your spouse. Let's say you're the only owner of a business, but your spouse is working in that business. It might make sense to pay your spouse. It doesn't always make sense. And actually, probably the majority of the time it does not. But when it does, it can have a really good impact on your tax return.
And you bring up that good point too. Like we're going to look at it only from the tax perspective, not the keeping your spouse happy by giving them a paycheck point of view. That's a whole nother thing. We are not in the relationship counseling business, nor should we be. We could probably do a pretty good job of that if we wanted to. But I look forward to this one. I think the biggest things that we'll get out of this, right, is what are the advantages of it, but then also when are the most common and best scenarios where it makes sense, but then also when it doesn't make sense. Because I think, Chris, you bring up that point too. As I've been traveling around with you guys for a while now, you do see a lot of the same questions just asked in different ways where it's really the same thing. Should you be paying your spouse if they do nothing? Absolutely not. Anyways, I won't give away any teasers to it.
There are non-tax factors that we're not going to dive into. However, let's take a look at when does it make sense to hire your spouse or pay your spouse? When does it not? A lot of it is what we've stolen from our friends in the military community, situationally dependent, right? And a lot of it has to do with your marginal tax rate, what type of entity you are, what type of profit you have in your business. Remember, diagnose, prescribe, right? Figure out where you're at. Your marginal tax rate's your number one key performance indicator when it comes to tax planning and strategy, and that should drive a lot of your decisions tax-wise. So let's talk about when it makes sense to hire a spouse. Okay. Number one reason would be and again, these are all under the assumption that the spouse is doing legitimate work for legitimate pay within the business. But the number one reason would be so that you can contribute to a retirement plan for that spouse. Now, what type of retirement plan? Well, it's going to depend on what your situation is. And typically, we've got two options when it comes to retirement plans. We've got your more traditional tax-deferred plans. It's going to be like a 401k, a SEP IRA, where there's an employee contribution and an employer match. Simple IRA is another one. And so if you are what's called a red diagnosis in the teaching tax flow community, red means high marginal tax rate. That means that tax deferral, an immediate tax deduction, and tax deferral, which is our purple diagnosis, might make sense for you. So if you're in that phase of life and you're in that marginal tax rate where you're trying to maximize the amount of money you fund into your retirement plan and your spouse is working in the business, this could double up the amount you can put into a retirement plan. Because why? You have two participants. Probably my favorite option for paying a spouse is someone that might be self-employed and they hire their spouse for legitimate work and they actually implement a solo 401k plan. With a solo 401k plan, even though it says solo plan, you and your spouse only can still contribute to that. And you can sock away over $100,000 a year. Now, you have to be careful. You have to make sure that you don't have any other employees or eligible employees to participate in the plan. And eligible employees that definitions changed a lot with Secure 2.0 Act. But ultimately, if you're listening to this and you have a spouse that works in your business and you want to maximize, you've already maxed out the amount you could put in your retirement plan and you're trying to contribute more for your spouse, and this could even be defined benefit plans, whatever plan it is, that would make the argument to, yes, let's hire the spouse so it makes sense.
And you struck a good chord there too when you talked about, legitimate work right out of the gate. And then that's probably a really good starting point here too, Chris, because that's one of the things that I see majority of, say there's a group of 6 of us, we're talking, it's a little bit different if we're at a tax pro event where it's all tax professionals. Cause I think, you guys all know the answer to it, but every once in a while somebody comes out like, oh, well, I'm going to pay my 2-year-old. It's like, what exactly is your 2-year-old doing in your, real estate flipping business? Is your 2-year-old dragging around a table saw or driving the truck? Probably not. But in some businesses, there are certain types of individuals. And I think that carries through too. I mean, I'm not going to point any names out here because I can think of one of my friends that I'm pretty sure that his wife, congratulations to him. I think he just got married about 6 months ago, but I'm pretty sure she's on the payroll and she does absolutely nothing. Again, I'm just making that assumption. But yeah, that's a big question.
And what's your buddy's name, John?
Well, it's actually anyway, John Trapolsky. No kidding.
Well, here's the thing. You're touching on paying, income shifting between family members is a tax strategy, right? Mm-hmm. Income shifting to children is a sub strategy of that. Income shifting to parents is another one. Income shifting to spouse, which we're talking about right now, or paying your spouse, is a sub strategy of shifting income. Now, it's different when you're paying your spouse because ultimately 99% of the time you're filing the tax return together anyway. So that's where it's a different calculus compared to shifting to people that you're not filing a tax return with. That's the thing that we have to remember when it comes to spouse.
Good point. Very good point.
Yeah. So we've got 3 reasons why you potentially hire your spouse. Not tax related, okay? There's tax.
Yeah. I like how you brought that one back into the mix. We cannot forget about that one. So
yeah, I mean, I guess there could be a 4th, but let's go number 2. To create deductible benefits. So here's the situation. Let's say you're self-employed, right? And you have a spouse that's helping you work in the business and you're paying a bunch of medical expenses. Your health insurance premiums are deductible. However, let's say you have a lot of medical expenses. Real story. I worked with a taxpayer on a personalized tax plan. is in the medical field, self-employed, no employees, and their spouse works and helps with the billing and bookkeeping in the business. This couple has a special needs child. They're spending about $40,000 a year on out-of-pocket medical expenses, therapy, all deductible. However, it's only a personal deduction subject to 7.5% of their income. So they can only deduct the amount that exceeds 7.5% of their income as an itemized personal deduction. Ultimately, the vast majority of this is a personal expense. Well, that we ended up hiring the spouse for the legitimate work and implementing something called a Section 105 plan, which is a health reimbursement arrangement. And now the employer, right, the medical professional is paying for the employee. Now, it's the only employee, which happens to be its spouse, out-of-pocket medical expenses. So the employee pays the out-of-pocket medical expenses and submits a reimbursement request to the employer, and the employer reimburses the spouse for the expenses. So now the $40,000 of medical expenses are considered an employee benefit, tax deductible, on Schedule C with this taxpayer happened to be self-employed. It's ended up saving them $15,000 a year when you add it up in tax. So there are other tax deductible benefits that could occur. What if you've got two people that are looking for health insurance and they need group health insurance? Well, they might put both spouses on the payroll. So there's a lot of reasons where situations where a spouse would be hired in that employee role to give them tax deductible employee benefits. In a bigger company, we talk about Section 125 plan benefits, right? So let's say you work at a large company, you get group life insurance, you get a portion of your health insurance paid for, you might get a health savings account contribution, you might get dependent care benefits, you might get reimbursed for educational expenses for at college or university. You can potentially use all those benefits as a small employer and hire your spouse, and it really works if the spouse is your only employee. That means there's a business deduction, and the spouse picks it up as a tax-free fringe benefit. So if you are in a situation where you feel that you don't have any other employees and your spouse is helping in the business, and you feel like you're paying a lot of expenses that could be a benefit if you were an employee somewhere, you might be in a situation where you want to hire your spouse to create these tax deductible benefits.
And just to throw it out there too, Chris, so we're talking about potentially hiring a spouse as an employee, not a contractor. This is not, I'm just going to cut him a check randomly once a year as a consultant. Doesn't work that way. This is somebody, and then hiring them on as an employee is actually putting them on a legitimate payroll too. So this is not just swiping a check over every once in a while. This would have to go through a legitimate payroll system, in theory, correct?
In that case, for tax deductible benefits, it does have to be an employee relationship. For contributions to a retirement plan, it could be a single member LLC and the spouse is brought on as a second owner. That's or paid as an independent contractor, and they contribute to their own retirement plan. But in general, we're talking about as an employee. That is correct. Now, the third reason would be is to reduce self-employment tax. Now, we know that self-employment tax is 15.3%, and it's paid on your self-employed earnings or W-2 wages, and there's a Social Security cap every year. So what happens sometimes is that I'll give you a real example of this. You have a client. So we had someone in our community, in our teaching tax flow community, and there were two spouses that were coaches. Okay, and I'm not going to get into their industry or anything like that, because you could have any type of coach. Actually, doesn't necessarily have to be athletic, but they're coaches, and they have a business together. And one of them, though, has another job where they're compensated rather well, and they're making about $200,000 a year on a W-2. Well, that spouse is already paid into their maximum Social Security cap So it'd save a lot of money if we allocated 50% of the revenue from the business, let's say it's a multi-member LLC, to the spouse that has a W-2 job and has already maxed their Social Security tax, instead of just allocating it to the one spouse and having the other spouse be free labor. Again, it has to be legitimate. But number 3, to reduce self-employment tax. And that could be a variety of reasons. And it could be where one of the two spouses is already at that Social Security wage base limit. So there's or it could go the other way, John. I've seen it the other way. I've seen it where clients, let's talk about multi-member LLCs. Let's say a client set up a multi-member LLC. It's a 2-spouse partnership. One of the spouses is working in the business full time. The other one is just helping out. But when they started it, they just slapped both of them on the LLC, right? So each of them are getting allocated $100,000 worth of, let's say there's a profit of $300,000. Each spouse is allocated $150,000 worth of profit, and they're both paying self-employment tax on all $150,000. Well, if one of the spouses is really doing all the work and the other one's kind of not doing a lot of work, you might want to especially allocate, $250,000 of income to one spouse and only $50,000 to the other one because they're not doing as much work. That would save you from the second spouse paying self-employment tax on $100,000. In round numbers, that saves you $15,000 in tax. So it depends on, the situation. So point is, if you're in a situation where both spouses are working together and you feel like you're getting hammered with self-employment tax, you might want to relook at how the income is allocated, especially if you've got one working in the business more than the other.
Mm-hmm. And I know we mentioned earlier in another one's too, everything's situationally dependent. There's really no yes, no, very binary answer to any of these, right? Every situation is different in some way or another. Like you just used that example, right? Of you might have a multi-member LLC, which that's a different scenario than it is likely many others. So it's kind of looking at it as I don't use that word holistically very often. I feel like it got kind of burnt out back in the day. Everything was looking at it holistically, 10 years ago, but with a fresh set of eyes, if you will, or from a bird's eye view, and looking at it and saying, oh, well, does it make sense? And, like the examples you gave there, just not really, I shouldn't say reinventing everything, but just kind of reallocating and shifting things around may make a lot of sense. And it's not like you're trying to beat the IRS at their own game. You're just setting it up. You're just setting it up a different way.
Correct. Right? So there's a variety. Yeah, absolutely. So reasons: potentially increase the amount you could put in your retirement plan, potentially create tax-deductible benefits, or potentially reduce your self-employment tax exposure. The fourth one could be potentially to give them, if they're working in the business, to give them some Social Security benefits. So to get money paid into the Social Security system. Sometimes people do that. We got to look at the ROI of the Social Security system, but sometimes, that could happen. Now let's talk about the flip side. When does it make sense not to hire your spouse from a tax perspective, right? First one would be we mentioned this as in the beginning, if it's abusive, right? If the person's not like your buddy who has allegedly hired their spouse and the spouse is doing no work, that's abusive, right? Remember, reasonable compensation for the work that's being done. Number 2, what if the administrative burden outweighs the benefit? When you hire someone, you've got payroll. You have to process payroll. There's a cost to that. Let's say it's $600 a year, right? And let's say there's some time involved. Now, if you're listening to this and you are worried about processing payroll, please let us know. We had an amazing podcast called Modern Payroll by our friends at Gusto. We can get you connected with them to make sure that it's as little cost as possible. But there's still responsibility and cost associated. So I'm not going to spend $600 a year to save $200, right? That's silly. What if, administrative, another issue could be someone, adds their spouse to their LLC, and now all of a sudden you've got a partnership tax return, and you've got thousands of dollars of tax preparation fees that you didn't have before for a minimum benefit. So the cost, part of teaching tax flow, diagnose, prescribe, IQ test, which means your financial fitting room, does it make sense tax-wise, and implement. So the administrative costs might outweigh the benefit. Let's say your spouse already has employee benefits, things like health insurance and all these other things with another employer. So by implementing an employee benefit plan when they already have these benefits somewhere else, obviously that wouldn't work. You could also trigger more tax. You could actually increase the amount of self-employment tax inadvertently without the proper planning. So that's another thing, and you got to make sure that the spouse. Let's say we've got some clients, and we have people in the teaching tax flow community where it might make sense to pay the spouse, but we might have a spouse that's on disability, and they're in, or maybe they're drawing Social Security, and the amount of income that they can earn is limited at this point, and during that period of time where if they earn too much income, they'd have to pay 50% of it back. So you've got to look at like you mentioned, holistic. You've got to look at the entire picture before we say, yeah, let's go for it. So
talk about a big moment, right? If you look at this, you're like, yeah, I did a great thing last year, brought my spouse on board, and then all of a sudden you're like, oh crap, I'm having to pay all these extra admin fees, and oh geez, now my taxes are actually higher than before. I probably should have talked to somebody about that. Oh gosh, I can only imagine somebody's kind of smack in the face when that happens, right? And that's a knee-jerk reaction to some of the stuff. I mean, I'll bring up the example too about you see it a lot. Social media is a great tool, but it's also a nasty little bugger when you're hearing bits of information. Oh, go out and buy a 6,000 pound vehicle at the end of the year, and they don't explain anything about it. And you go out and buy a truck, and you're, oh man, well, crap, I still have to pay for this thing. It's not free. And that's just my favorite example.
No, I mean, buying a vehicle, in my opinion, is not a tax strategy. It's a business decision that has a tax benefit, an immediate tax benefit. It's not a strategy, Well, to put a bow on it, let's think about this. What are the pros, right? You could potentially create tax-deductible wages for the business. Again, you're going to be filing together. You might be able to enable retirement plan contributions, health insurance premiums. You could keep your household income within the family. So let's say you own a business and one of you have an office manager that leaves the company, and you think your spouse is a great fit for that. That could work, and it could reduce self-employment income. What are the negatives? Potential IRS audit risk if the employment's not legitimate. You could actually increase your household taxes, right? There could be an administrative burden, and you could be paying, like I said, extra Social Security taxes on top of the administrative burden. So let's think about things. Think about if this might make sense. Again, if you know someone or yourself has a business and you have a spouse working in the business, think about compensation planning as a really great tax planning tool. And join us in the Defeating Taxes private Facebook group.
Awesome. Where we provide great tax information and no spousal consulting. So we'll leave that to somebody else in the mix. But hopefully you guys that have listened to this or had the opportunity to actually watch this, if you can. I didn't make any funny faces at Chris this episode, so sorry, you won't get any of those. But as we mentioned here, I think this is a great way to look at it. It's our goal here is really to give you the information. And as we mentioned, every situation is so different. Take a look at what you have. Talk with your personal board of directors, as we've referenced in many, many podcasts now. That's your tax professionals, your attorneys, anybody who you can think of that you kind of surround yourself with or get in your circle, and look at it and say, does this make sense for me? And again, it might not. It might sound better than it is in your certain situation, but really you're the one that has to take the first step to figure that out. So take a look at it. Hopefully you got some good information from this. Any questions, drop us a line directly, or as Chris had mentioned, get in that private Facebook group, drop them in there. Tons of individuals in there that can give you some great information. We do a pretty good job of monitoring that too. So if anything's said or referenced that, we might deem as not exactly the best, we usually can weed those out. But really, we haven't even had to do that yet. So we haven't had to play, the mom or dad coming in and slapping any hands. So everybody's behaved themselves pretty good. So as we say that, let's wrap this one up. We are in the thick of the holiday season. So we imagine you'll have a little bit of extra time on your hands, after between the family showing up or leaving. Hop online, check us out. So obviously, if you haven't watched us on YouTube, check those videos out. We started way back at episode 100, posting those on there. Let us know what you think. As Chris mentioned also, let us know some of the topics that you may want to hear us discuss. We've got a good amount of them planned out, I think even into 25, but everything's pretty fluid. So we can change things up as needed. And again, the community is pretty much what drives our content here on the podcast. So shoot us those content ideas, shoot us those questions, shoot others those questions, and we will see you back here again on the Teaching Tax Flow podcast next week, roughly the same time, totally different topic. Have a great week, everybody.
The content provided is for educational purposes only. We encourage you to seek personalized investment advice from your financial professional. For all tax and legal advice, please consult your CPA or attorney. Investment advisory services are offered through Cabin Advisors, a registered investment advisor. Securities are offered through Cabin Securities, a registered broker-dealer. The content of this podcast does not constitute an offer of securities. Offerings can only be made through an offering memorandum, and you should carefully examine the risk factors and other information contained in the memorandum.